important wave structure update from my trading warrior brother, Peter Goodburn, in the gold. Peter, if you followed his work, is one of the hardest working Ellioticians I know. Also has added his own style and techniques and fib measurements to um, differentiate himself from other Ellioticians. So why don't we start, Peter? Welcome back to TradeGateHub. It's been a while. In fact, it was interesting. We had booked this, I don't know, a few weeks ago, and on one of my daily videos where I do an update, one of the comments was, "When are you gonna get Peter Goodburn back here? His work is excellent." So anyway, the vibe was out there. Welcome. So this parabolic move actually will have an end to it, Peter. Tell us what you're seeing for your targets now and how you derived it.
Yeah, we're talking gold, aren't we? Because
Yeah,
of course it's the big outperformer at the moment, and yeah, it's going parabolic. There's this big exponential rise. It's done a bit more than I thought in this particular part of the sequence. We had intermediate wave three targets some months back at 42.62, but we thought that was a bit of a fantasy for this time period, only because back in August we'd already started seeing sentiment get a bit skewed to the upside. In fact, I was reading today a little bit from Mark Hulbert, who does a sentiment index,
right.
and this is
Yeah.
a graphic that was part of an article that he posted today. Um, it shows basically gold timers. I mean, he's obviously looking at these for extremes in contrarian sentiment.
Yeah, he's been around a long time. I mean, Holberg goes back to the 70s and 80s, I remember. And
Yeah.
yeah, so he rates the timers, and that's how he comes up with his views. So gold, the most extreme it's probably been in probably since 2011, maybe.
Well, he thinks that that's going back to, well, you can see here market timers bullish than at any
Oh,
time since 2000. So we're going back
e-
25 years.
so that's even more than the last bull run that we had in 2011. And silver did go to 50 then. Gold wasn't even close to
No, no.
4,000. Yeah.
And he said in this article that in August we were at something like the 92nd percentile of extremes in bullishness in August. And he
Right.
said that now that's jumped up another several percentage points, and it's now at the 98th percentile. So in other words, there's only been 2% of periods in going back to the 70s where we've been seeing more bullish extreme than this. And I
I
think,
can say something, Peter, that I've noticed, especially with the last few huge updates, or maybe the last two, $300 in gold, is that prior to last week,
hmm,
the miners were leading the way. They were outperforming the physical. And I've
hmm.
noticed, even though they're making marginal new highs, they're only making marginal new highs. They don't look as parabolic as the physical markets do. Could that be a tell that we're getting close?
Well, I think you're right. I think that the other thing is, of course, when we take a look at sort of ETFs against an underlying commodity, you have to differentiate because there are ETFs that are equity linked,
Right.
and there are
GLD.
ETFs that are commodity linked. It's a bit like what we were looking at the other week on some of the energy markets, like XLE and XOP. These are energy ETFs which are linked to the equity, the big oil and gas companies,
Right. Not
and they
WTI.
actually have a very different rhythm to crude oil. I mean, the
Yeah.
XLE and XOP are still, pretty much near their recent 2-year highs. But if you take a look at oil, we're down 50% from the March 22 highs. So
Right.
you have to make, differentiations there. And of course, at the moment, we've had a very good run up in the gold miners. Let's have a look at
Huge.
GDX.
I think we haven't gotten to your target. I think it's Everyone, I'll let you know I read Peter. I'd feel, you know, I'd feel like part of my intelligence gathering was would be definitely challenged without it. Okay, so you have it peaking here where I think we've gotten to 36.76.
Yeah, we've just been there in the last few days, and it's getting right up into that sort of barrier, and it's looking a little bit overstretched on some
Yeah,
of the technicals.
yeah.
I think something like Newmont Mining. Let's just check that one.
Yeah, and
Um,
I use RSI, and it's not confirming the high with momentum indicators
yeah,
right now.
bit of divergence, you mean?
Yeah,
Yeah,
yes,
bearish divergence. Yeah, this is equivalent a third wave. It's not quite there. Let's just check the daily. Yeah, this is just coming into sort of resistance now. But
okay,
it's not appreciably high like bullion, so bullion's
right,
really, as you say, bullion is vastly outperforming. Another thing to gauge whether a correction's coming is to have a look at the gold silver ratio,
yeah.
which
Looks
I'm
like
I'm looking at every
getting a
single day these days.
get a bear market rally. So you think there might be one more push down in this last rally in gold?
Well, it's marginal, isn't it? Because
Yeah,
if these measurements are coming from 107,
yeah,
we've been already down to what? What's that low there? 80.43.
yeah,
And we're talking about 79.63. It doesn't necessarily have to drop. I think it probably will, actually. Um, that might mean that silver does a bit of a catch up.
yeah.
But you see, the thing,
Okay, go ahead, and then I'll ask my question.
yeah,
Go ahead.
I think the main point here is that silver, or gold, the gold silver ratio is declining from the 107 high. Don't forget that's April, that
Right,
high, which was when gold and silver bottomed at that time and started this latest trajectory higher.
right,
And we've counted down in 5 waves. This is silver's obviously outperformance, so it's
right.
narrowing the ratio, which means silver's outperforming. But once this pattern is confirmed as completed, and perhaps we will get sub $80 slightly, and then we should get a correction. So when this bottoms, that should mean a top for silver, and it should mean a top for gold as well. Because
Okay,
then we go through a correction. This is normally directionally linked, you see, the gold silver ratio. It's not like some of the spreads that we do in the fixed income world, where you can have you can have bullish flattener or a bullish steepener. You can go both ways. It's not necessarily directionally linked, but this is, and that specifically means that if we do get the completion confirmed in this 5-way decline in the gold silver ratio, and we start to get a correction back up to fourth preceding, and this is just a 38% correction, it could do a little bit more, then you're going to see quite a bit of a shakeout in the gold silver, and that's when we can time the next decline. So I've been looking at gold today because some months back we had 42.62 as an upside target for the bullion gold, but we thought that would be that was
later.
we thought it would be later. Yes, we thought it would take a bit more time. But what's happened is that we had this consolidation pattern following the April high.
Right.
And then, of course, it's done a lot outside of that since. So that triangle is good because triangles in this location can't be anything else but other than a fourth wave.
Right.
So we can immediately discount the B wave or an X wave because that's the only other places where a triangle can occur. So we know that this is a fourth wave, and if this is a fourth, then if we work backwards in the logic, then we must say that this entire move from 1810 is the third. But that also means that we're in the fifth, and that has a finite amount of upside potential. Now, we could have extended intermediate wave one by a factor of a Fibonacci 138.2. That would have taken us up to something like 4,700. But if we see equality in waves 1 and 5, and I don't often use the equality ratio in 1 and 5 because most impulse waves, no matter whether they're a first wave extension, a third extension, or a fifth extension, they would normally adhere to the golden ratio from start to finish.
Okay.
But there are instances where Elliott himself noted that waves 1 and 5 measure the same. Now, this is a logarithmic scale chart. So what I'm going to do now is I'm just going to select 100%. All right, it's already selected. And you'll see that this approximates, if we go to the completion of wave 4 and the beginning of wave 5, you can see there this blue line coming in at
Yeah.
this number. And that's a Fibonacci 123.6% extension above intermediate wave 1. So that's the correlation between the connection between waves 1 and 3, but it's also giving you a connection within the subdivision of wave 3. So I think that even though we've seen a big jump even in the last week, in the last 2 weeks especially, this is the nearest Fibonacci ratio convergence that we have next on the list, because we had lower targets coming in just below 4,000. Now that we've jumped above it, I think this is going to be the next test. So I think personally that this will be enough, particularly given what Mark Hulbert is telling us about the 98th percentile extreme. It sounds and feels a bit like, we're in the last stretch.
Okay, so gold achieving 42.62, what's going to be the high that you project in silver, especially with the gold silver ratio, maybe one more low and bottom out? It would seem that silver would be the preferred short for a contrarian counter trend trade.
Yeah, that's right, because it would then undergo some sort of underperformance. So if you were going to short the markets or buy an inverse ETF, something like that, you would probably choose silver to short over than gold. Some of the targets that I had are being tested at the moment. I've been playing around with a few alternatives on silver.
Everyone's waiting to uncork the champagne bottles at 50. Are we going to, that would be a prime sentiment thing. Get over $50. They'll call it a breakout over a double top on the monthly, and it measures $75.
Yeah.
Could that be where we
Well, here's
peak?
why $50 you're referring to is so important, because we've got the old 1980 high here. This is obviously an intraday closing. A closing monthly chart. So actually, it shows up as $48, but we do know that 50 traded. Well, I know at 50 traded because I was actually trading it at the time.
I was too.
I
had
was
a client short silver coin bag contracts. I was a broker in Beverly Hills at the time, and they went limit bid, and he was short, and he ran a deficit on me, and I had to pay for it.
Yeah.
So I'll never forget the highs in 1979, 1980, and the Russian invasion of Afghanistan. That ushered in a 20-year bear market.
Well, it did. I mean, this is it. When you get an exponential rise, you often get an exponential fall, and you end up with a parabolic. So this is one of the things that we always learn in financial markets. Commodities obviously are very prone to these types of exponential rises. And there's more than a few people who think that we're involved in this type of trajectory at the moment. Well, in theory, we are. But even if we break down sort of this pattern up, there are quite severe sort of movements down in between. They don't look it here because it's a logarithmic scale, but there are quite severe corrections along the way. Silver, as you can see, since that time, we've labeled this as a B wave of an expanding flat, A down, B up, and C down. And the reason for that is because of the amount of overlaps going on. I remember this particular area. This is the financial crisis sell-off here.
Yeah.
And we had that as a nice expanding flat at the time, A, B, C, an expanding flat. And then we had another zigzag to come. The problem with that was that when the next rally occurred, it unfolded into 3 waves, and then we collapsed in 5, which implies that's a running flat. That's pretty spectacular. I mean, it's almost impossible to predict that, actually, I have to say. You might be directionally, after the expanding flat, you would have been long silver. So we were actually projecting higher levels at the time, but not quite in that way. We thought this would develop into 5 waves, a B wave down, and then C coming up here.
All right. Well, we're not going to 138 right away. What do you have for a potential high in silver when gold's at 42.60?
Well,
And gold.
I'm working on, because I only
Okay.
finished the gold a few hours ago,
All right, man.
and I
All
got to
right.
come up with some new
Do you have
numbers.
a note from mom that you came to this interview without a silver chart?
I will be
Uh,
publishing that. So whatever I'm
okay.
doing tonight, I will be publishing the silver chart tomorrow, because
All right.
tomorrow we have a new schedule for our Elliott Wave Compass report,
Okay.
and we'll be publishing that. Maybe we can tell everybody about details that towards the end, but
Okay.
we'll be publishing the silver chart tomorrow.
Okay. And so finally, and the dollar's knocking on the door of, I have a trend break at this 92.80 in Dixie. And I believe you think this is just a bear market rally, but um, perhaps the dollar rally finally has an impact on the metals.
Well, I think probably so. I mean, my original assumption when we were back here in July, August time was that when we put in a low for the dollar, that would put in a high for the precious metals.
Right,
Um, but of course, we have already put in a low for the dollar at
right.
96.22. We were marginally below that from July's low, only a few pips. So at the moment, my assumption on the timings was wrong, because the gold and silver prices are still holding up despite the dollar nudging higher. But that might change. They don't always turn on a dime. So we often get a bit of timing dislocation. But ultimately, if we're right in assuming that the dollar is in a corrective rally, um, and I believe that's the case, then we will get, I think, eventually some exertion with dollar. And I mean, that will be probably where the headlines start to change.
Yeah,
And you start to see, them saying, well, the dollar's stronger, and that's the reason why the precious metals are lower. I must say, though, that one of the other things that have been brought to my attention today, because I've had some institutional clients calling in saying, Peter, your palladium um, prices have broken some overhead resistance. So I think anybody tuning in at the moment, just keep a look on this. But it may not be the best time to buy palladium. It might be best to wait until gold and silver have worked off something of a correction down. But palladium has given us the first clues that it's starting to break upwards. If I
yeah,
can find it, just a
yeah.
second.
And it was the weak sister for a long time. It was
Yes.
the last one to take off. You know what reminds me of, Peter?
Yeah.
That first you have the blue chips rally, then you have the S&P rally, and then you start to get the Russell and the trash going to the upside,
Yeah.
and the Johnny come latelys. I think that's what Palladium is saying, that the metals are becoming really speculative when you start to get these kind of moves in Palladium.
Yeah. Yeah.
Do you think?
And it's breaking up. Up until now, this rally that we had from 828, this rally here, it looked very corrective into this high in July.
Yeah,
And it was touch and go whether it would break down again, but it's broken. It's finally broken that resistance. So that's one of the first key signatures that we should be thinking about palladium at some stage. Don't necessarily buy the breakout immediately, because it's still a little bit risky until we've satisfactorily topped out in gold and seen what sort of type of effect occurs with the correction down on silver as well. But it's certainly something that you should be looking at, because historically palladium, like platinum versus gold, is very undervalued. And
yeah,
even, and so that's certainly a signature. Platinum is moving up at the moment. It's finishing 5 waves up from April. So that one's going to undergo a correction. And if that does, you'll probably get a chance to buy palladium on a dip later. But it's certainly got to be worth something to think about, because it's very, very inexpensive. And palladium, I think, could be seeing some sort of narrative change. The whole reason why palladium fell out of favor was because of this whole
catalytic converters. Yeah,
exactly, catalytic converters in diesel falling out of favor. But it wouldn't surprise me if suddenly people wake up and realize that palladium is a necessary metal for these data centers or something like that. And then it suddenly ticks off, and before you know it, this thing is, accelerating very high.
Okay. Well,
Anyway, worth thinking
uh,
about.
yeah, thank you for that, Peter. You know, that's what people have to pay attention to. You could miss the leader and catch the follower for a catch-up move when manias are are in play. You have been constructive, called that break in the S&Ps into April, and your count from there was we're going to go up to about 7,500. But you think there could be an interim correction to shake people out right in here where we are now before we head up to 7,500.
Yeah, it does seem that way. I mean, if we take a look at some of the Mag 7 as well, which of course are leading the markets, the Mag 7s have got a very similar recovery point from April. Actually, I've got it on my other screen, so I
You
need
know,
to take
Peter,
it.
it's interesting that you say that because I just interviewed a guy a couple hours ago who shows, the leadership in by sector and
Mhm,
everyone talking about the concentration in Mag 7. But
mhm.
actually, the outperformers the last 3 or 6 months have been more commodity stocks.
Mm.
And what used to be ranked number one, like AI and the triple Qs, they're down the list quite a bit compared to other sectors, uranium. I mean, basically a lot of things that if you drop it on your foot, it hurts.
Yeah.
So they're really not leading. Commodity stocks have been the stars besides quantum.
Yeah, no, I
What do you,
agree. I agree. And I think that's come out because, there's a lot of concern about valuation at the moment. Um, as you know, quite a few of the luminaries and veterans of hedge fund industry have been talking about the fact that things are a little bit overstretched. And yet the investment banks here, for example, are talking about extrapolating price earnings ratios. Um, and um, and and of course that is really sort of where the investment banks are still looking at earnings per share increases, and they're just extrapolating them on. The problem is, and this is a piece from I picked up from Yardini. You can download it. Anybody can download it from his website. But this is the misnomer about price earnings extrapolation, because a lot of fund managers swear by price earnings as a forward guidance for whether the price of the S&P or the Nasdaq might go up or down. But here you can see going back to 95, and he's done a very good job, I have to say, in building this. The red line is the actual fourth quarter sum. So it's basically the sum of the price earnings. You can see the trends. But if you know the trend of the stock market, you can see that this is the 1990s bull market.
right,
Here's the 2000 dot-com
right,
bubble. And
right.
then we go up into the pre-financial crisis. Here's the recession for the financial crisis, and then off we go again. But the thing is that these little squiggles, these blue squiggles, are what price earnings are over the quarter period. And you can see that they are tracking the price action, not the other way around. They're not giving forward guidance at all. In fact,
Wow.
post financial crisis, if you look at this, the initial forward earnings was correct there, that it was increasing right here from 2009 to 2010. But from 2011 onwards, 12, 13, 14, all these years, you can see these squiggles are all turning down, and yet the price is roaring to the upside. It's completely wrong.
So a lot of assumptions that people have that have them long are false assumptions.
Yeah, but I have to say that a lot of asset managers, and I know a lot of them, are using um, um, basically this idea of earnings per share
Interesting.
as a model for their portfolios, and it's completely wrong. I mean, if you look through to this period, the only time that earnings per share increases here is in 2018, and that was precisely when the market topped in intermediate wave three and declined.
Okay.
So, so
It's
really, it's
certainly a
not a
vote
very
for certainly a vote against fundamental analysis compared to price is king TA?
Well, I think so. I think there's a lot of misconception in stuff like this. As far as the Mag 7s, you're right. There's been a certain amount of relative underperformance. The semiconductors are quite interesting. Obviously, the two big ones of semiconductors. So we're talking about the SOX ETF.
Yeah.
And the two big ones are NVIDIA and Broadcom. NVIDIA is close to topping out 190 out of target. It's not far from that, so it's getting close. But Broadcom, for me, is already topped out. I'll show you what it looks like. Where are we? Here we go. So this is Broadcom.
Okay.
Now we're going back to October 22. There's a big 5-wave pattern here. Here's the first wave.
Yeah.
Second. We have
Yeah.
5-wave third. And then we have, from the third wave, we have the beginning of the fourth. It comes down, rallies 3, and then drops 5. It's a really nice running flat. That's pretty much consistent with expanding flat patterns that we had in the underlying indices like the S&P, NASDAQ, and a few of the other equities. And it wasn't replicated by every equity in the Mag 7s either. Actually, Microsoft unfolded into a zigzag. That's really nice. If you get two corrective patterns which are different, but they're moving in sync up and down, this is where the integrity becomes very high. That's when you create really good, stringent forecasts to trade on. And when we had this decline down to 138, that was wave 4. And then we get the fifth wave moving up. Now, our fib price ratios, we've taken a 61.8 correlative ratio of 1 to 3 equals 5. That's the mathematics. We briefly touched through and down. And the decline from the high at 374.23 is 5 waves. And we started that at the beginning of the month. And we've since unfolded into correction. But that, to me, suggests that it's already topped out. Now, that means that we're already undergoing a correction down. The amplitude we can discuss, whether it's a 23% correction or a 38% correction. I've just put an indication for the 38% number, which is 161. That's a long, long way down. I don't know whether it's going to get that far, but it gives you an idea of what to expect. And if this one is already leaning over to the downside, then the other shouldn't be too far behind.
What a great interview. Outstanding again, Peter. The analysis of gold and silver and the shares and the dollar and really elite stuff. And I wanted to talk about, and we probably went on a little bit too long, but you've been in the business, you've been trading. What was your first job in the business, Peter? Do you remember? Because I don't, but anyway, do you?
The first part of the question was intriguing. The second part.
Well,
sorry, could you repeat the question again?
Yeah, Peter, do you remember
I
when
haven't
you
got
were
Alzheimer's
young?
yet.
Do you remember when you were young? All right, go ahead.
No, in all seriousness, I actually was a rookie trader. I began my professional career at 18 years old. I came from college and I started work at a company called Billiton, which still has its name. Yeah, well, it used to be called, Billiton was its own mining concern. It was actually one of the biggest miners in the world at the time.
Yeah.
And it was owned actually in those days by the oil industry because there was a booming metals market in the 80s, post Bretton Woods. So all the big metals, like copper was the biggest contract in the world at the time, that was moving up. And the largest copper amount of trading was done in London, not New York.
Right.
COMEX was a futures contract, but the London Metal Exchange was a point delivery. You could deliver copper at any day during the financial year, any day, 365 days a year you can deliver and get a price on your exact date. So there was this, it was huge in those days. In fact, it was even trading before the bond markets got going. So in terms of London, when I worked for Billiton, I was working for the exchange subsidiary. So we
Wow.
were members of the London Metal Exchange,
Right.
and we used to go down to the exchange every day, twice a day. And we used to have a pre-market in the office, and then at 11:30 we had 15 minutes to get to the exchange. So it was like, grab your coat, grab your jacket, get across to the exchange as quickly as possible. The bell would ring at 12 o'clock, and that would be the start of copper trading in the pit.
Yeah. So you were on
And
the floor. Were you on the floor trading it?
I was trading it on the floor.
Okay.
Um, and actually, my job at that time was clerk, to the managing director. And we had some of the biggest order books. In fact, we had the biggest order book on copper down on the market. And for some reason, all the busy brokers had two clerks, and my company only had one. That was me. So I was flying around the ring. As soon as the bell rang, you had 5 minutes of frantic trading. I mean, frantic. And then when that bell rang, it automatically rolled into the next metal, which was tin trading.
Wow.
And then my managing director was sitting in the ring, and I was clerking behind, writing down all the deals and the transactions in this 5 minutes of complete frenzy. And when the bell rang, it was my job to go around to the other brokers and just with their clerks and check the trade and
Yeah.
matched
So you
off.
so you wouldn't have an out trade the next day.
Well, the problem was that Tin was trading, and my managing director was throwing his arms around the whole ring doing trades,
Yeah.
and so I had to watch him as well as doing the checking from the other side of the room.
Yeah. What a way to break into the business. You were thrown right into the fire.
That was a baptism of fire.
So
That
let
was
me ask you this. When did you discover Elliott Wave and did you have a mentor or what books? Was it Proctor's book that first influenced you to go to Elliott?
well. I tell you what I was doing. I was commuting from South London when I was a kid, and I was listening to the radio, one of these pocket radios, and there was a talk show called London Broadcasting Corporation (LBC), and they had a guy on there who was talking daily um, about Elliott waves. He just
Uh,
published a book called Super Timing. His name was Bob Beckman, and he was talking about Elliott waves, and he was publishing his book prior to the Frost Practice sort of book.
wow.
So I got listening to that
Sort of.
actually. Yeah, I got listening to him, and and wondered what all this was about. And I'd saved the idea for a while, and later I met somebody at another company which I joined later after Billiton, and he was actually taking some of practice stuff, and then I started practicing in the office myself. Now we didn't have intra-hourly charts in those
No.
days,
Everything by
so
hand.
everything was done by hand, and we needed an hourly chart, so we could only do an hourly closing chart. We couldn't have bar charts because I had an alarm clock on my desk and it would beep every hour. And then I would quickly write down the price from the screen and kept an hourly Dow Jones chart or something like that.
Mm.
I also got
Wow.
copper charts, which are like 3 meters long. I've still
Okay.
got them in big frames in storage somewhere.
Yeah,
Yeah.
I used to use commodity perspective and CRB charts back then. I'd carry it around. I'd have coffee stains on it, ketchup, mustard, and my friends would say to me, you know how friends are when was on the wrong side of things. Dale, turn your charts upside down. So Peter, from point A to where you are now, we all know that, when we first started, it was and still is very important about our P&L. But when you spend a lifetime doing anything, what has trading done for you as far as discovering who you are, your strengths, your weaknesses, dealing with adversity, handling success without hubris? Um, Tell us what trading does besides change your account balance every day.
Yeah, very good introspection. Well, I have to say that if you bring an ego to the markets trading, prepared to be quashed. Because as much knowledge as we accumulate and trust with all of the work that we can do, the analysis and the thoroughness of it, always be prepared to be humbled, because it will crush your ego. I've seen setups and scenarios look really bulletproof, and yet they still can fail. They don't, those are a bit outliers, but they're still very, very humbling when you see it. Not only humbling when you're wrong, but very humbling when you're right. Now, to be humble when you're right, rather than your ego go eccentric, is also a very good lesson that we can all learn. Be also very forgiving. And when I say that, I don't mean forgiving to somebody else, forgiving to yourself. One of the big things which I had to learn, and I learned this from the markets, is that to be self-forgiving, forgive yourself. Don't be too harsh on yourself. Actually, in the new age of today, we learn to love ourselves. I never understood this. It took me a few decades to really understand about the forgiveness of oneself. The other thing is, and that's one of the things that the market can teach you. The other thing is that never have regrets. A regret is simply something, an error that you've made that you haven't learned from.
That's the key.
You must never have regrets. Every regret must be turned into something positive. Learn something from it. Otherwise, it's a waste. Life is a journey. It's a journey of self-discovery, and the markets can help you reveal that, because you're completely challenged all the time. If you go along in life and you're not challenged, you're really wasting your time in this incarnation. Learn as much as you can through life, and the markets will teach you if you only have ears to listen and eyes to watch. It can teach you a lot. Be very humble. Don't be self-punishing. Forgive yourself, love yourself, and always, from your lessons, always learn something, good or bad. Whether it's a positive trade or a negative trade, always try and learn something. And I think then, you begin to really go through a point of self-development. In fact, the markets accelerate that self-development, because often you will encounter things, trades that maybe go wrong are very challenging, or even trades where you're making money but don't know whether to take a profit yet or not, or let it run. We've talked about this type of thing a lot.
Yes. Yeah.
This is also a skill, to hold in there. I remember when the S&P was running up in intermediate wave 3. Do you remember that target I had for Dow at 42,000, and it was trading sub 20,000 at the time?
Yeah.
And I was absolutely convinced, because of the ratio and proportions that were coming, that would be the case. But to be long for 3 or 4 or 5 years in that move where you go from sub 20 up to 42,000 is quite difficult.
Yeah.
But you learn so much, and you begin to recognize some of the baggage that we hold on our backs. We often don't understand that we all carry baggage around. There are shadows, cumulative shadows around. And if you go into sort of a Tibetan school, or you go into meditation school, the one thing that you're really encouraged to do is to let go of all of those negativities. And one of the big advantages that I find is doing a meditation, trying to get into a rhythmic meditation in the morning before coming into the office, and just letting things go through the forgiveness, release all of the baggage, and just let things flow. I mean, one of the things is that, like the gold price upswing at the moment, I had some really great fib price ratios which have been busted to the upside. We were in the right direction, but they were busted. sometimes you've got to let things go and then remeasure, reevaluate. Even if you get some really good solid analysis, you've got to be prepared to let go. Let
You
go.
could
And
always you could always find a reason to beat yourself up in this business. I was long, I got out too early, I didn't have enough on. Even when you're right, you could still find a way to beat yourself up. I think that
don't
is
do it.
really, yeah,
Yeah.
people get fetal, go fetal on losses, do cartwheels on gains. And what I say, Peter, is that we all are trying to get to the place where it's just another trade.
Right. And always learn from it, because even if you're jumping out too early and the mind, don't beat yourself up. Congratulate yourself. But learn. Learn. Is there anything I could have done that would have kept me in a bit longer or got me out sooner? Is there anything? Always go through that improvement. Even if you don't find the solution, don't give up. Always persist. Never, ever give up, ever. Always persist in that move. And eventually, you will find that if nothing else, you're going to be a better person for it.
Okay, well, you just heard from Germany's version of Rocky Balboa, and Rocky Rocky never gave up, buddy. He got up off the canvas. That's the spirit. So, Peter, it was great hanging out with you, like it always is. Why don't you let people know how they could follow your work and keep in touch and get your silver target, and show your website.
Thanks very much. Well, yeah, this is wavetrack.com, and this is our main page. And we have, by the way, on the right-hand side in the news alerts, this is basically links to our blog. And we have an annual and a mid-year video update in three different sections, part 1, 2, and 3, just to let everybody know that the mid-year section went out in June, July, and August. It was basically stock indices, part 1. Part 2 was commodities, and part 3 was currencies and interest rates. And we really look at the very longer term patterns at that point. For short term work, which will include the silver chart that I'm going to update in tomorrow's report, which is the Elliott Wave Compass report, the subscription is here. So we go to subscription and click on that, and you can see it here. And we're going to be updating that in the commodity section. We normally update in this report gold, silver, and crude oil. But it's a bit of a mix of asset classes. The main reason for that was that it was conceived because of demand from our institutional hedge funds. They're multi-managers, most of them. A few of them are owners of billion-dollar hedge funds, and they like to take an overview and look at correlations. So even if you're not trading all these different asset classes, do what the hedge fund guys do, what the big guys do. Think in bigger terms. Think in terms of cross asset allocation, what the correlations are doing between stock markets maybe and the dollar versus US 10-year yields, this type of thing. We find that it's giving us some great signals, and at the moment we're going to be upping the subscription for the first time in 15 years next month. It will jump from $39 to $54. So if anybody's tuning in and wants to get the old rates, you can still do that. So we'd be very much pleased to hear from you if you would like to join us in our community.
So check Peter out for your intelligence gathering. I do. Not that I'm always intelligent, but I really like his work and I read it all the time. And Peter, I appreciate you coming here and sharing for free, like you have for years. Your giving spirit of coming on and sharing great market calls, win, lose, or draw. Very good market calls and very interesting work that you do. Um, Glad to call you a friend.
Thanks, Dan. I really appreciate that.
All right, so everyone check out my Trading Warrior brother, Peter. at Elliott Wave Track, WTI_first. And he's not real active on Twitter, but you'll get a couple of updates a week from Peter if you go with the subscription, or should I say, when you go with the subscription. So, adios, brother. Don't just count your pips, count your blessings. Our paths having crossed, I count as a blessing. Thank you, Peter.
Yeah, thanks a lot, Dal. It's great to
Forgive
talk to you, and
and
all
forgive
the
yourself. Don't just forgive others. Don't forget about yourself. Forgive yourself. And
exactly.
I have
Love
to
yourself.
I have to do it every day. So
We have to.
yeah, thank you, bro. That's a wrap. Peter Goodburn, everybody.